You are welcome to Unit 4. So far, we've been looking at general tax administration in Ghana, principles of taxation, and treatment of employment income. In this unit, our concentration is on assessment of business income. When we talk about business income, it is described as profit or gains from any business carried on by a person for whatever period. In determining business profit or gains, the taxpayer will deduct expenses for the period from the gross income for that period. The result is the net profit for the period. However, not all expenses that are set against gross income to determine net income or net profit are acceptable by the tax authorities. In this unit, we are going to consider deductions that are allowed and deductions that are not allowed for tax purposes. We'll also look at capital allowance and finally assessment of business income. We start with this session by looking at deductions allowed and deductions not allowed. By the end of the session, you should be able to state the meaning of deduction, explain the principles in allowing deduction, state and explain at least 5 allowable deductions, and lastly, state and explain at least 5 non-allowable deductions. We start with the meaning and principles of deduction. A deduction is a legitimate business expense which has to be allowed in determining profits. Deductions are business expenses and they are applicable to self-employed and companies. The law relating to deductions to be made in arriving at the profit or gains which are chargeable under the Act are contained in Act 896, Section 9. Let us look at the principles in allowing a deduction. The principles in allowing deductions found in the Act 896 are the outgoings and expenses must be wholly, exclusively, and necessarily incurred in the production of the income. Let us look at these keywords one after the other. When we say wholly, it means that the whole amount must be used for the business purposes. When we talk about exclusively, we are saying that the purpose for which the expenditure was incurred must be for business purpose. In other words, the expense must be a relevant factor in the operation of the business. When we talk about necessarily, it implies that the expense must be inevitable. In other words, without incurring the expense, the business cannot go on. Let us look at some of these deductions allowed. We have interest. Some payable by way of interest upon any money borrowed by the person where the commissioner is satisfied that the interest was payable on the capital employed in acquiring the income. That interest becomes an allowed expense. Then we have rent. Rent payable by any person in respect of land or buildings occupied by him for the purpose of producing the income is an allowable expense. However, if any part of such building or land is occupied for domestic or private purposes, that portion for such purpose is not allowed to be deducted. Then we have bad debt. A deduction is allowed for bad debts incurred in the normal course of the business other than advances made on capital accounts. A bad debt is allowed as a deduction if the Commissioner General is satisfied that the taxpayer has taken all reasonable steps to pursue payment and the person reasonably believes payment will not be made. We have to also note that any amounts recovered in respect of a bad debt previously written off should be included in income and subject to tax accordingly. The next expense we have research and development expenditure. Any expense incurred by a person on research and development for the purpose of developing the business, improving its product or process is allowed. However, the business needs to produce a certificate issued by the minister responsible for industry in support of the research and development program. Also, the commissioner may determine whether the full expenditure under this paragraph shall be deductible in respect of the year of assessment in which it was incurred, or whether it shall be spread over subsequent years of assessment. Then we have capital allowance. Capital allowance is the same as depreciation. They follow the same principles. But in taxation, capital allowance is granted in place of depreciation. Capital allowance is granted in respect of a depreciable asset owned and used by a person during a year of assessment in the production of the income of that person for a business. When we look at the third schedule of our Income Tax Act, the Act or the schedule provides us with specific provisions that we have to follow in computing capital allowance. We will treat this into details from section 2 to section 4 of this unit. Then we have deductions in relation to the rental of premises. Any sums paid as local rates by individuals from rent received to any local, urban, city or district council in respect of any residential or commercial premises, and a mortgage interest on sums borrowed for the purpose of constructing or acquiring such premises is an allowable expense. Then we have foreign exchange losses. Foreign exchange losses incurred in the production of income during the period in respect of any debt claim, debt obligation, or foreign currency holding of that person, where the commissioner has been notified, is also an allowable expense. In the 2023 budget, the government proposed to limit the deductibility of foreign exchange losses to only realized losses and restrict exchange losses on capital assets to be capitalized other than deducted in the year in which they are incurred. Then we have carry over losses. Tax losses can be carried forward for all sectors and deducted from assessable income for 3 years immediately following the year in which the loss was incurred. Specifically for priority sectors, they can carry forward their tax losses up to 5 years. So when we talk about priority sectors, we are talking about farming business, mining business, manufacturing business, petroleum operations, energy and power business, agro-processing business, tourism business, and ICT business. These are the businesses in the priority sector, and they are allowed to carry forward their tax losses up to 5 years. Any other business, you are allowed to carry forward loss for 3 years. In the 2023 budget again, the government proposed a unified period of carryover of tax laws to streamline the administration of the carryover provision. Next, we have finance costs. Deductions for financial costs other than interest are limited to the sum of financial gains derived by the person in the year of assessment and 50% of the adjusted chargeable income of the person for the year from the business or investment. When we say adjusted chargeable income is income from business or investment without the inclusion of the financial gains derived by the person or financial cost incurred by the person. In other words, adjusted chargeable income is calculated as the chargeable income from business or investment without including financial gains derived by the person or financial cost incurred by the person. Then we have charitable contribution. Some contributions or donations are allowed as deductions in ascertaining the taxable income of a person. So these include contributions made to a charitable institution or fund approved by the government. We also have payments towards a scholarship scheme approved by the government for a technical, professional, or other course of study. We also have donations made for the purpose of any rural or urban area and approved by the government. We also have donations for the purpose of sports development approved by the government. We also have donations to the government for a worthwhile government courses approved by the Commissioner General. Another allowable deduction is repairs and improvements. Any expense incurred for repair of premises, plant, machinery, or fixtures employed in acquiring the income or for the renewal, repair, or alteration of any implement, utensils, or articles is an allowable deduction. However, if any such items are employed in part for domestic or private purposes, such portion is not allowed to be deducted. In spite of the provision, the Act allows a deduction of a percentage of capital expenditure relating to repairs and improvement. According to Section 12 of the Act, it provides us with specific rules for deductions of expenditure relating to repairs and improvement, and it stipulates that the expense should have been incurred for the repair or improvement of a depreciable asset. 2. The repair or improvement expense incurred is wholly, exclusively, and necessarily in the production of income from an investment or business. And lastly, the repair or improvement expense may be of a capital nature. So here, there's a limit. The deductions allowed in respect of an expense for repair and improvement of a particular asset shall not exceed 5% of the written down value of the applicable pool that depreciable asset held at the end of the year. So let us look at an example. The Ladem Limited incurred expenses of 2,500 Ghana cedis on repairs and improvements of plant and machinery and declared a profit of 100,000 for the 2021 year of assessment. Note that the written down value of the applicable pool before capitalizing any excess is 60,000. So we first have to find 5% of the written down value and compare it to the expenses incurred. If it is more than that, we'll have to restrict it to the 5% of the written down value. If it is less than that, it will mean that the whole amount incurred in respect of repairs and improvement of plant and machinery is allowed. So let us see how we'll go about it. So let's have workings. So we have 5% times 60,000, which was the written down value of the pool at the end of the period. 5% of this gives us 3,000. This 3,000 is more than the amount incurred in respect of repairs and improvements of 2,500. This means that the whole amount is an allowable expense. So that's for workings. Now let us look at the computation. So we have profits as per account. We're told the person made profit of 100,000. Then we add repairs and improvements, the whole amount 2,500, and this is going to give us an assessable income of 1,0250, and this is giving us our assessable income. Then we less the allowable repairs and improvement, and we said that the allowable repairs and improvement is the whole amount because it does not exceed 5% of the written down value of the pool. So we are deducting, it's going to give us 100,000. So 100,000 is our adjusted profit. And if there are no other expenses allowed or disallowed, this 100,000 is what we are going to tax for the year for that business. Let us look at another example where the expense exceeds 5% of the written down value of the pool. Nkrumah Limited incurred expenses on repairs and improvement of 6,500 on a plant and machinery, and also declared a profit of 100,000 for the 2022 year of assessment. Note that the written down value of the applicable pool before capitalizing any excess is 60,000. So now let us look for our deductible amount. So A, deductible amount for repairs and improvement. So 5% times 60,000 is equal to 3,000. So that is the allowable R repairs and improvement. So we are going to deduct this from the 6,500 incurred to get the expense not allowed. So not allowed. We have 6500 minus 3000. We have 3500. So 3500 is not allowed. It is also the excess amount of repairs and improvement. Okay, so let us look at how we'll do this computation. So we can have solution 1, profit as per account. They gave us 100,000. Then we have add back repairs and improvements of 6500. This is going to give us 106500, and that is our accessible income. Then we have less R&I, repairs and improvements allowed. So we are going to get 6500 minus 3500. So we have 3000. That is what we did here. So we are lessing, and this is going to give us 103500. And this is our adjusted profit. If the business is subject to any rebates or some other deductions, we do that and then we get our profit to be taxed. So if there's nothing else to add, this 103500 will be taxed for the year. You can also solve this by just deducting the you can also solve this by just adding only the non-allowable expense. So solution 2, you have your Ghana cedis here. Then we have reported net profit, which is the same as profit as per account. We had 100,000. Then we have add back repairs and improvement not allowed. So into bracket we have 6500 minus 3000, and that's giving us 3500. So we add back, we are going to get 103500, and that is our adjusted net profit. As simple as that. So you can either go by this or you go, so you can either use the first solution or you use the second solution, whichever one you're comfortable with. Okay, we also have advertising. It's also an allowable expense. However, adverts of permanent nature are treated as capital expenditure and they are not allowed. So normal advertising in the media is allowed, but adverts by, let's say, permanent signboard is treated as capital expenditure and not allowed. We talked about bad debt. So here, general provision for doubtful debt are not allowed, but specific provisions are allowed. Then we have legal expenses. It is allowable for defending rights, protecting assets, collecting debts, current companies matter, and it is not allowed in the formation of partnership and companies, sale of property, income tax appeals, breaches of law. We also have premiums paid on lease. This is not allowable, but interest aspect of the payment is allowable. Now let us look at deductions not allowed. The Act 896/2015 stipulates some deductions that are not allowed. So we have domestic or private expenses, including cost of travel between residence and place of business or employment. We have any disbursement or expense not being wholly, exclusively, and necessarily paid or expended for the purpose of acquiring income. Then we have capital withdrawn or any sum employed or intended to be employed as capital. Then we have capital employed in improvements. We also have any sum recoverable under an insurance contract of indemnity. We have rent of or any expense in connection with premises or a part of premises not occupied or used for the purpose of producing business income. Depreciation of any fixed assets and any payment to a savings or other society or fund unless specifically allowed by the Commissioner General. This brings us to the end of today's session. In today's session, we looked at deductions that are allowed and deductions that are not allowed in determining the chargeable income of a business organization. Hope you enjoyed this session.